Legendary investor Warren Buffett once famously stated the following: "You know, we think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. It's a protection against ignorance." Now, most investors would agree that Warren Buffett's amongst the greatest investors of all time. And because of that, this quote can be confusing and potentially detrimental to less experienced investors. And I would need more fingers and toes to count how many times casual investors have regurgitated this quote while explaining how diversification is for idiots. The truth is, diversification is critical for building and, more importantly, sustaining your wealth over the long haul. Combine it with dollar cost averaging into the market to book your ticket to retire with style. Dollar cost averaging is when you invest a set amount of money each week or each month to avoid trying to time the market. Time in the market beats timing the market all day, every day. In this video, we'll take a further look at the value of diversification and add more context to Warren Buffett's quote. Before that, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this, smash that like button, subscribe if you haven't, and tell a friend about the channel. I really do appreciate you. Let's go. What is diversification? Diversification is simply not putting all your eggs in one basket. The purpose of this investing strategy is to mitigate your losses by spreading your money over multiple investments. If one of the companies that you select ends up being a dud, you'll have plenty of other winners to make up for those losses. It's good practice to own multiple companies across a variety of sectors. And you can take this a step further by investing in low-cost ETFs across different sectors that cover different indices or trends. Why diversify? Let's start by addressing the opening quote to this video. Buffett is oftentimes in interviews asked specifically why his funds are concentrated in a few companies. And his answer is usually something like, well, those are the companies that he understands the best. He puts in 5 or more hours a day of deep research on all the companies that he invests in or is potentially going to invest in. This increases his confidence in his top few positions, which he considers his best ideas. He thinks that going with his top 3 to 6 stocks will produce superior results to going with his 7th best idea. Now look, his definition of knowing what you're doing is very, very different than your or my definition. And this is where inexperienced investors get themselves in a lot of trouble. And I'm honestly not even gonna provide a direct quote here because he spams this answer all the time. This is like his primary canned response. He believes that 99% or more of investors should roll with a low-cost S&P 500 fund. So if I'm putting this together properly, he's basically saying that 99% of us don't know what we're doing, and I would agree with him. If you don't put in 5 or more hours of deep research about your investments every single day, you are in the 99%. And let's be honest, we have way better things to do with our time. So hence, over 99% of us fall into this camp. There's nothing wrong with it. It absolutely does not mean you're an idiot in any way, shape, or form. So with Mr. Buffett's recommendation of rolling with a S&P 500 fund, like I choose VOO, ticker symbol VOO, which is just an S&P 500 ETF. You buy one thing to get access to 500 of the largest companies in the US. And remember, you are a legitimate owner of each and every one of these companies. You will be making profits, whether it's in price appreciation with the value of the company going up over time, or direct dividends in your pocket on your employees' production. It's the exact same kind of ownership of buying an individual company or 2 or 3. You just own a smaller slice of these 500 companies. And this form of ownership will automatically update your holdings as new companies skyrocket into the S&P 500 and other companies inevitably go bankrupt or just stop performing at a top 500 level. You don't have to waste your time researching to know which new companies to buy or how to time this. Like, okay, do I need to get out from under this company? I don't know, my gut says this. You don't have to make any of those calls. You just buy one simple basket, for example, VOO, and there's other S&P 500 tracking funds, and you genuinely will beat 90+% of active funds. This is an actual stat with research behind it, not just my opinion, over any 20-year stretch. And just to finish the section of why diversify, when Warren Buffett eventually passes away, if that ever happens, he's giving a ton of his money away to charity because he's an amazing human being. But what doesn't go to charity, 90% of it to provide for his family will go into an S&P 500 fund, with the other 10% being cash equivalents, specifically short-term treasuries. So that is how much he genuinely believes in his own advice. It's not do as I do, it's not do as I say, it's do as I say and do. Why not diversify? I do not believe there is a single good reason to not diversify your funds. And this includes professionals. I respectfully disagree with Warren Buffett. In the past 30 years, 90% of actively managed funds, aka professionals, people that do this for a living, have fallen short of the returns of the S&P 500 ETF SPDR, SPDR. And that was the first ETF that tracked the S&P 500. I highly recommend reading the Little Book of Common Sense Investing by Jack Bogle, who actually created the first S&P 500 tracking index, so this came before the ETFs of the world. It will truly give you context on just how well this works over time. It's not a fad. It's not if a recession is coming, if we're in a bull market, bear market. It truly doesn't matter. Dollar cost averaging into the S&P 500, the market, wins. Some people's argument for why not diversify is actually the exact same as the definition, only opposite. So instead of buying 20 companies, you should buy just 5 companies. That way you only have 5 winners. So one of the 20 doesn't perform, you don't have to offset the gains to cover the loser. Basically, if you know 3 to 5 stocks extremely well, you'll only pick winners. Much like Warren Buffett, who concentrates his money primarily in his top few holdings. I mean, he has many holdings, and we'll look at that in a minute, but he's really concentrated at the top. They believe in the same thing, only Warren Buffett's is based on a completely different reality. Warren Buffett has a mind-boggling 19.8% annualized return since 1965. The S&P 500 in that time frame is 9.9%. And you might think, wow, so he's doubled your money compared to the S&P? He's actually doubled your returns? And that would be incorrect because of our friend compound interest. He has over 150 times the returns as the S&P 500 in that timetable. But normal investors like you and me will not have access to the same level of data or bailout bargains compared to the Warren Buffetts of the world, regardless of how much we study. We're in a completely different world. And even if we did, let's check out how his fund compares to my passively managed portfolio over the last 10 years. And my point isn't to say that I'm the next great investor. It's actually to prove that these passively managed solutions have a lot of merit in today's market. If Warren Buffett suggests that 99% of us mere mortals should invest in low-cost index funds, who am I to argue? Especially when a simple solution can outperform most of the big boys, including the Oracle of Omaha himself. Let's take a look. All right, so we're jumping over to Portfolio Visualizer to do a back test. And we're going to take the last 10 years, that's 2014 through 2023, year to date, yes, so that's through August this year. Our initial amount is going to be $10,000, and we're going to contribute $1,000 per month. Reinvest dividends is on, and here's our portfolios. So portfolio 1 is the modern 3-fund portfolio that I use. Portfolio 2 is Berkshire, which is Warren Buffett's fund. And portfolio 3 is the market, S&P 500, which is ticker symbol VOO. And you can see I have an equal mix here for the modern 3 fund in this scenario, and then 100% for the other 2. So when you hit analyze, we're gonna go down here. So the final balance with the modern 3 fund portfolio is $281,000. Berkshire is $251, and S&P 500 is $241,000. So here's the annualized returns. You can see that Berkshire's by far the highest in 14, way down in 15, up in 16, and then kind of steady, way down this year in 19. So it's a little bit volatile, but then it's up when the other two are down. So definitely not a direct market correlation there. The other two trend together. So the modern 3-fund portfolio is the blue here. It looks pretty solid across the board for the most part. And the S&P 500 is the yellow. And notice that the blue beats the yellow every single year, no matter what. It's up more or it's down less as you look at each individual year. And so now the important part here is to look at the annualized returns. So this is the total return. For the last 3 years, Berkshire has been going nuts at 18% compared to 12 of the modern 3-fund portfolio and about 11 for the S&P 500. In the last 5 years, the modern 3-fund portfolio is up at 14% compared to 12 and 11 of Berkshire and S&P 500 respectively. And for the full almost 10 years, the modern 3-fund is 14.3% compared to 12.2% of Berkshire and 11.7% for the market. Verdict: diversify and still have fun. I'm not going to put 100% of my long-term investments into an S&P 500 index fund. Now look, I'm pretty darn boring, but come on. I really do enjoy putting my money in some stocks and ETFs that I believe in. And I've had good luck, probably dumb luck, in that my individual stocks have outperformed the S&P 500 each year since 2019. Now look, I don't think that I'm an exception to the rules, and I do still put 90% or so of my long-term investments into low-cost, passively managed ETFs. I dollar cost average in, like I preach, and I just let it ride long-term. The portfolio that I recommend, and that I also use, has outperformed the S&P 500 for each of the last 10 years. And this is no BS. If you want to see the portfolio makeup and the 10-year backtest, check out this video right here. Thank you so much for watching, and I will see you here next Thursday. Peace.